Excellent. All right. Well, let's get started. So again, my name is Jason Dahl. I am a certified financial planner with AFS. I think some of you know me. In fact, I know some of you know me. I work primarily with our individual financial planning and wealth management group, but I also give this presentation and others to our 401k clients as well as a part of our sister entity, AFS 401k Retirement Services. And so I'm excited to lead today's presentation on Social Security. Just a couple quick housekeeping items. So first, let me give my contact info up front. We have it on a slide at the end, but just in case you aren't able to stick to the end, my email address is jasond@afsfinancialgroup.com. So my first name, Jason, my last name, initial D, like Dahl, at afsfinancialgroup.com. So, and I mentioned that up front because I just want to say that if you have questions or you want to get specific about your situation, please feel free to shoot me a note as a follow-up to today's presentation. I'd be happy to help you as best as I can. But throughout today's presentation, you're also welcome to submit questions. I know some of you actually submitted questions in advance, so we will address those. But as we move along, and as things pop up, you may have a question. So at the bottom of your screen, you should see 3 little icons, and one of them says Q&A. I think that one is the best one to use. So if you have a question, if you just click that Q&A icon, a little dialog box will open up, and you can type in your question, and I will do my best to address those as we go. And in some instances, I might say, hey, we're going to cover that in a few slides later, or I might just say, hey, I think this is a little specific, and maybe we follow up on it offline directly. But yeah, so without further ado, I also want to, I guess, mention too that I have studied a lot and learned a lot about Social Security over the last few years, but I'm still amazed how often I will get a question or a scenario that's posed to me where I'll say, that is a really good question, and I think I know how that would play out, but I'll say, let me double check it, because there is just a lot to Social Security benefits. And that, if there's one thing I really hope everyone takes away from today's presentation, is really understanding just how valuable Social Security is, and potentially how complicated it can be. And it really depends on your situation, the degree of complexity. So I really encourage folks to take your time to really think through what is the best claiming strategy for you, because as you're going to learn as we go throughout this presentation, there's a lot to it, and many of you may be eligible for benefits based on multiple pools of benefit, not just kind of the traditional when do I start and receive my own benefit. All right, well, let's get rolling here. So this lovely lady is Miss Ida Mae Fuller. She was the first beneficiary of Social Security, and she received check number 000000001 for $22.54 in 1940. So quick question for everybody to think to yourself, or feel free to submit it. Does anyone know what the Social Security full retirement age was for Miss Fuller? So at what age was she eligible for her full retirement benefit back in 1940? And then as an extra credit, what do you think her life expectancy was in 1940? So I will go ahead and share that with you. Her full retirement age in 1940 for Social Security benefits was age 65. And now the life expectancy question is a little bit of a trick question, because at the time of her birth, her life expectancy was just age 62, which is kind of interesting, right? Considering that the full retirement age benefits were 65. However, as many of you know, life expectancy changes, right? It extends as you live, right? So at her age 65, she was expected to live on average another 14 years to age 79. So that kind of begs the question, well, will there be a last Social Security check? Is somebody going to be the last recipient? And really, it's important, I think, to address the elephant in the room that is the financial well-being of Social Security. And I know some of the pre-questions that we've received really were around this. Whether you're already receiving Social Security benefits, or you're getting close, or maybe you're a lot younger and Social Security benefits are still many years away, this is one of, if not the most common question we get is, well, is it even going to still be around? And so I always like to just kind of give a quick background explanation of kind of the two key components that go into Social Security benefits. First, there is what I believe everyone is probably familiar with, your Social Security payroll taxes, right? So we all pay 6.2% of our income towards Social Security taxes, as well as our employers pay 6.2% payroll taxes. And if you're self-employed, you know you pay both of those, the employee and the employer portion of that. And so that is ongoing, right? We all pay for that, and that's kind of the idea of the younger workers are sort of funding the benefits for the current beneficiaries, and then that cycle kind of repeats itself. But there's also what's called the Social Security Trust Fund, which think of it as like the savings account component for Social Security. And so the benefits that are being paid come from a combination of the ongoing payroll taxes that are being paid by current workers, as well as that savings account. And whenever you see those dire reports in the news that talk about how Social Security is going broke and it's going to run out of money somewhere around the year 2032, specifically what they're referencing is that trust fund, the savings account. So the current projections say that if there are no changes made to the Social Security benefit structure, the trust fund is projected to run out of money around the year 2032. However, even if that were to play out, the projections also say, and this is the part that I think a lot of people sort of gloss over because it doesn't quite create as good a clickbait, as they say, but even if the trust fund were to run out of money, the projections say that the ongoing payroll taxes that are being paid would still cover right around 78% of all of the promised benefits. So in that kind of doomsday scenario, that sort of worst case, the benefits would be reduced by around 22%, but there would still be Social Security benefits paid. Now, having said that, do I think we're going to do nothing? Do I think Congress is going to never make any additional changes and we're never going to have a president who's going to sign those changes into law? I realize we think that might be pie in the sky given some of the current state of affairs in Washington, but I firmly believe that we are going to make those changes eventually. And frankly, Social Security is just way too popular, way too successful of a program for them not to make those changes eventually. And quite honestly, the changes that need to be made are pretty straightforward. It's a fairly simple math equation. So some of the changes that are being talked about are simply pushing the ages back. Remember I talked about Miss Ida Mae Fuller, her full retirement age was 65. Well, back in the 80s, Tip O'Neill and the Speaker of the House and Ronald Reagan, president at the time, got together and they were able to work out legislation where they bumped the age back. So, and we're going to talk about those different ages here in a moment, but at some point I think they're probably going to push that back even further. So under current law, for example, my full retirement age is age 67. I fully expect by the time I get there, it's going to be pushed back. It's probably going to be, who knows, 69, 70. Right? Because we're living longer, and that's a fairly straightforward change that can be made. And with that change alone, that prolongs the trust fund projections. They could raise the cap on the earnings limit. We'll talk about this some more too, in terms of how much of your earnings is subject to the 6.2% payroll tax. There's some talk about means testing. So for high income retirees, they might say, oh, we're gonna means test a portion. That's just scratching the surface. There's a lot of other ways that they could make changes to prolong that trust fund. So having said that, my last comment on that is I am 42 years old. I fully expect to receive Social Security benefits someday. I am that confident, but I also fully expect the rules to be altered by the time I get there. All right, just a couple quick notes here, then one of the other most common questions we get is, well, when do most people start collecting? When do they file? And as you can see on the left-hand side of the screen, most people file what we call early. And so this is going to be a recurring theme, so it's important to point out. When I say filing early, that means filing at any point prior to your full retirement age, okay? And in this example, you see that 69% of all current recipients of Social Security benefits are receiving some form of a reduced benefit because they filed early, okay? This is also a key component to today's presentation. Keep in mind that if you file early, so again, that's filing prior to your full retirement age, you're going to get a reduced benefit. So just keep that in mind. I'm going to explain all that in more detail here in just a moment. And then on the right-hand side, part of the stress that is falling on the Social Security Trust Fund is the fact that people are living longer, right? I just mentioned that. And as you can see, there's almost 1.8 million recipients now that are age 90 or older, right? That's a lot of years that they've been receiving Social Security benefits. And as you can see right down below, 61% of them are women. And so while this is an important subject and very worth your time and effort to make a smart decision, it's particularly important for women, given the longevity expectations. And so here, to me, these three bullet points really summarize just how important Social Security is, because for most retirees, Social Security is going to be their only source of guaranteed retirement income that they cannot outlive, right? It's going to pay them for the rest of their life, regardless of how long they live, that also has some form of a COLA, or cost of living adjustment, right? It keeps up somewhat with inflation. And that combination of things is really valuable when you put it in the context of your overall retirement plan. And so Social Security is definitely worthwhile, worth your time and attention. And so this is awesome that we've got such great turnout for today's presentation. It's a great first step to really be thinking about what's the best decision for you. All right, I'm just glancing here at a comment that came in. Interesting. Yeah. So the question, if I may kind of summarize, is so even if the amounts for Social Security were to be less, do you find it likely that the government will give other perks, i.e., medical coverage, 100% to make up for it? Wow, that's a big question, and that is definitely, I'll say, on one level, kind of beyond my crystal ball. But I think kind of I think where you're going with that question is oftentimes when we think of our payroll taxes, we think of not only the Social Security piece of it, right, the 6.2%, but there also is the 1.45% that goes towards Medicare, right? And so, right, that's a hot topic is with the the presidential debates around healthcare in general, but and specifically Medicare. And so could they juice up, if you will, the medical benefits as a result of reduce and in turn reducing Social Security benefits? I don't know. That's a great point. It's an interesting thing to think about. So will Social Security be enough, right? I mean, I think everybody recognizes that you're probably not going to be able to recreate your pre-retirement income solely from Social Security. And to kind of give you a sense for sort of the national averages of what percentage Social Security replaces of your pre-retirement income. So on average, when you look across the entire country, right, which is and the income levels, the average income level across the country, Social Security replaces about 40% of the average wage earner's income. However, you have to kind of now slice that a little bit finer and say, well, it's different for folks who were above average earners as well as for below average earners. So for higher than average income workers, which, it's a lot of folks in the metropolitan areas, right, or professional careers, you could probably expect Social Security to replace about 30% of your income. And for lower than average earners, Social Security replaces somewhere around 55 to 60% potentially for income earners. So regardless of where you fall, it's not going to replace all of your income from work. Now, kind of to the earlier point of when do people file, and as we pointed out that most people file early, and the unfortunate reality, I guess, is that most people file early because they need it, right? They're either unable to work or they're still working but earning at such a low level that they just can't afford to wait to receive their Social Security benefits. However, I do know that some people file early, honestly, just because of misinformation, or they just didn't fully comprehend the impact of filing early, or they just think, gosh, I think Social Security is going broke, I better get it now while I can, which I would caution you against having that be your primary rationale for doing it. But that's one of my missions, if you will, for presenting on Social Security so often, is to help folks not make a decision based on misinformation. All right, so now let's kind of start getting into some of the weeds, if you will. So let's first just sort of go over the basics of how you qualify for Social Security benefits. So you need to earn 40 credits. That's how Social Security benefits are based. So you have to earn 40 credits. You can earn up to 4 credits per year. So in essence, you need to work and pay Social Security taxes for 10 years, right, to then earn your 40 credits. Now, how do you earn those credits? Well, in 2019, for every $1,360 that you earn, you get 1 credit. So it's a relatively modest level to earn a credit. And then, so you only need to work 10 years to qualify. However, your benefit then is based on your highest 35 years of earnings, right? So it's basically between 10 and 35 years of work, right? They're going to look at your work history and the benefits paid and calculate your benefits accordingly. Now, the wage base, I mentioned this a moment ago, that the 6.2% tax, it actually only applies up to, and in 2019, it's $132,900. So let's just say your wages were $133,000 in 2019. Well, you would have $100 in that example that's not subject to the 6.2% Social Security tax. As a quick aside, that's different than the Medicare component. The Medicare component has no cap. And like I said, that's one of the things they're talking about is, maybe making Social Security like Medicare and have there be no cap. But under current law, there is a cap, and that cap goes up incrementally every year. But from a more practical perspective, I highly encourage you, if you haven't already, go to the Social Security Administration website, which is just simply ssa.gov, and you can create a login and log in and view your earnings estimates and benefit estimates and your earnings history. And I encourage you to do this first and foremost, not only to just kind of get an idea of what your projected benefits are, but just to scan through and kind of do a quick audit of the history of earnings that they have reported, because it's estimated that in about 20% of the cases there are mistakes or errors in the reporting. And so it's good to go back and check that to make sure the Social Security Administration has the correct earnings history for you. And in most cases, it's not an error that was caused by the Social Security Administration. What oftentimes happens is if maybe you worked for a really small employer at one point and they just didn't properly report your earnings. That's what we most often see. And you can then report that back to the Social Security Administration, and they will help you get that corrected by, if you have an old tax return or old W-2, that's the best way to get that corrected. So I encourage you folks to do that. The image on the screen is the picture of the old green statements. They used to mail those out every year right around your birthday. They stopped doing that entirely and tried to push everyone to go online. And then a few years later, they kind of reinstated the mailings. And so now they mail them every 5 years, and they're all just black and white. So I guess it's a cost savings. no more little green stripe on it. So you'll still get one in the mail on every 5th birthday, but you can go online at any point to look at your benefits. sorry, I'm just kind of reading through a few of the, one more comment here. How do they figure out your income number? Yes, it's based on taxes. And if you left the country but still filed taxes, do they take that into account? Yes, I think we addressed most of that question. But the part of it, if you worked out of the country, it just depends on if the wages that you were earning. In this, a little bit more detail than I can go into right now. But it basically comes down to, were those earnings subject to Social Security taxes? And that really depends on what kind of foreign earnings you had. But if you were paying the 6.2% Social Security tax on it, then yes, that would go into the calculation. All right. So the range for when you can file for Social Security is between ages 62 and 70. So I've talked a moment ago about your full retirement age. And so when you go online and you look up your benefits, they're going to show you your benefits at 3 different dates. They're going to show you your benefit that's at your full retirement age. They're going to show you your benefit at the earliest possible age of filing of 62, and they're going to show you the benefit projected at the latest filing age of age 70. So in this chart kind of shows you what the different ages are first. So if we look here, based on your year of birth, your full retirement age is either 66, 67, or somewhere in between. So if you were born between 1955 and 1959, your full retirement age actually goes up in 2-month increments. So 66 in 2 months, 66 in 4 months, and so on. Until under current law, everyone who was born in 1960 and later, your full retirement age is 67. Now, I like to refer to the full retirement age as kind of the magic number when it comes to Social Security benefits, because everything is kind of based on that age and that projected benefit. Because then what the Social Security Administration does, the way they think about it is they say, okay, if you file earlier, so at any point prior to your full retirement age, so that could be, so if your full retirement age is 66, if you filed at 65 and 11 months, that's considered filing early. Or if you filed at 62, right, that's still considered filing early. So alternatively, you can wait and defer your benefits beyond your full retirement age, okay? So let's talk about that, both of those scenarios. So if you were to file at the earliest possible age of 62 and your full retirement age is 66, your benefit is going to be permanently reduced by 25%. If your full retirement age is 67 and you filed at the earliest possible age of 62, your benefit is going to be permanently reduced by 30%. And here in the middle, you see the permanent reduction, somewhere in between those levels. Also, if you wait and file at some point beyond your full retirement age, for every year that you wait, you get credited with what are called delayed retirement credits. So the Social Security Administration is going to simply increase your benefit by 8% per year that you wait. And you don't have to wait a full year. It's actually pro rata by month. So if you waited to 67 and 2 months, you would get a pro rata delayed retirement credit. So that's in addition to any cost of living adjustments that get applied, as well as if you're actually still working and still paying into the system, and if those years that you're still working qualify as among your highest 35, then every year the Social Security Administration is recalculating your benefit based on, oh, okay, we now have a new high 35 years of earnings. You delayed it a year, so you get an 8% delayed retirement credit, and there was a cost of living adjustment. So they're redoing those calculations every year, or every month if you go in to file for it. All right, and I'm going to point out another reason why the full retirement age is considered the magic number here in just a moment. But I really like this chart as just kind of a simple illustration of the kind of the wide range of benefits you may receive depending on when you file. So this chart assumes that this person's full retirement age is 66, okay? So right in the middle there. And in their case, their full retirement age benefit is $2,000. Now, to use the lingo that the Social Security Administration uses, because you're going to see this, they call this number your primary insurance amount, or PIA. I simply refer to it as your full retirement age benefit. But it's the same thing. So the Social Security Administration refers to it as your PIA, or primary insurance amount. Okay? So now, in this example, we say, all right, full retirement age is 66, but I can file as early as age 62. So remember, that's going to result in a 25% reduction in benefits. So I could file at 62 and receive $1,500. So for the purposes of this chart, that is our baseline, okay? So that's our 0 point, because that's the earliest possible age I could file. Now we've just sort of gave a simple illustration of the percentage increase for every year that you were to wait. How much the benefit goes up, right? And this is as close to a guarantee as you're going to get, and it's a pretty good one, as you can see, the percentage increases. And so if you were to wait all the way to age 70, and again, that presumes you can afford to do that. We'll talk more about that. But that's a 76% increase between the earliest possible age and the latest possible age. All right, so it goes from 1,500 to 2,640. And again, that doesn't take into account the cost of living adjustments that may be applied along the way, or if you're still working and paying into the system, as I talked about a moment ago. This is just purely the percentage increase by waiting. All right. All right, so one of the other common questions we get, and we always love talking about, is taxes. So the question is, well, are my Social Security benefits taxed? So I'm now in retirement, I'm receiving Social Security. Do I pay taxes on that? Well, you may and you may not. It depends. So in essence, nationally, approximately 1/3 of all recipients have to pay income taxes on their Social Security benefits. And at most, up to 85% of your benefits are taxable as income at the federal level. And so there's, down there at the bottom of the screen, you can kind of see there's depending on your total income, that's what drives whether or not your Social Security income is taxed, and then how much of it is taxed. Okay. So for most folks who were higher than average income earners, if you worked as a professional in a metropolitan area, you can pretty much bank on, yes, 85% of your Social Security benefits is going to be included in your taxable income at the federal level. Okay. Now the next question is, well, are they taxed at the state level? So let's see here. What's the exact number? There's actually tax relief for retirees in 27 states and DC. So it's not taxable at the state level. So for right around this area, DC, Virginia, and Maryland do not tax Social Security benefits in retirement. But there are some states who still do tax. I think it's around 21, I guess, or so states that do tax Social Security benefits. All right. So here's where one of the other really important components around determining when to file and why I call the full retirement age the magic number. And this is one of the other reasons why you may not want to file early. All right, and forgive me for repeating myself, but just making sure this is crystal clear. Filing early is at any point prior to your full retirement age. Okay, I hope that's crystal clear at this point. So if you file early and you are still working, so you have wages from a job or net profits from self-employment, your benefits may be reduced, or a portion of your Social Security benefits may be withheld. So as you can see here, if your earnings are above a relatively modest level of $17,640, that's the 2019 figure, and those go up a little bit each year. But if you were earning above that level and you filed for Social Security benefits early, then $1 of every $2 earned above that limit is going to be withheld from your Social Security benefit. All right? And then they have a kind of a funky rule in the year that you actually reach your full retirement age. So if your birthday was in September, you reach, but so that up at for the 8 months leading up to that point, it's a different threshold. So it's anything above $46,920, $1 of every $3 earned is withheld. It's a little bit of a complicated scenario, but the two important things to consider. One, once you've reached your full retirement age, and that's what's here on the bottom line, you could file for benefits and work and earn as much as you want. It's the withholding is irrelevant at that point, right? That's kind of why I call it the magic number. Once you reach your full retirement age, you could file for benefits and work and earn as much as you want, and your benefits will not be subject to any withholding. On the flip side, if you're considering filing for benefits early, but you still expect to work, in most cases it does not make sense to file for benefits. And again, there's a disclaimer there. It's in most cases. Everybody's situation is different, and that's where you really need to kind of think through, and where folks on our team can help you think about, oh, should I or should I not file early? I'm considering it, but one of the important variables is, well, whether or not you're still working or you think you're going to work. All right. So let's just do kind of a quick recap. So far, what we've really been talking about is benefits based on your own work record, right? You've worked, you've earned your 40 credits, they're looking at your highest 35 years of benefit, they're now calculating your primary insurance amount or your benefit that's projected at your full retirement age, right? That's everything we've been talking about. So this slide is just kind of a quick recap of everything we've been talking about. However, for many people, you may be eligible for more than just a benefit based on your own work record. You may also be eligible for a benefit based on a spouse's work record, or an ex-spouse's work record, or a deceased spouse's work record. So we're going to kind of talk about those scenarios here. So, based on a spouse's work record, the amount that you may be eligible to receive is up to 1/2 of your spouse's benefit. So even if you didn't work or have benefits and your spouse worked and qualified for benefits, and let's just use easy math, say your spouse's benefit is $2,000 a month, then your benefit is potentially up to $1,000 a month. But I say potentially because, remember, if you file early, even for a spousal benefit, if you file early prior to your full retirement age, even a spousal benefit will be reduced, okay? So that's why it's up to $1,000 in that example. So who qualifies? It's spouses as defined by the federal government. So they clarified a few years back that same-sex spouses also qualify. And you need to have been married at least 1 year. And you can file for a spousal benefit once your spouse has also filed for benefits, okay? And then at that point, you could file as early as age 62, or wait and get the full 1/2 at your full retirement age. But an important note also is spousal benefits do not receive any kind of delayed retirement credit. So the max you can get is 1/2 of your spouse's full retirement age benefit. Even if your spouse waited to 70 and they're getting those delayed retirement credits, you're only eligible for 1/2 of their full retirement age benefit. All right? Well, what about ex-spouses? So yes, you may also be eligible to receive benefits based on an ex-spouse. All right, so just a few of the criteria. Well, actually, let me just point out, the benefit is calculated, the amount is basically the same as for a spouse. If you file early, it's reduced. The most you can get is 1/2 of the ex-spouse's benefit, and there are no delayed retirement credits. So that's all the same, but there are a few differences, right? You need to have been married at least 10 years. You need to have been divorced for at least 2 years. And you can't be remarried. In essence, I always joke that if you're considering getting remarried, before you make that commitment, maybe on the second or third date, maybe it's a little a little much on the first date, but ask them to bring their Social Security benefit estimate to see how it compares to what you think you might receive on an ex-spouse. I kid, but only a little bit. And then you become eligible. Like I said, you could file early at 62 and get a reduced ex-spousal benefit, or get the full amount, the full 1/2 amount at your full retirement age. So let me just add a couple other quick comments here. So in addition to the 10-year rule, there is a special rule that applies only to divorced spouses. So this is different than current spouses. So it's a divorced spouse can claim benefits on a former spouse's earnings record, even if that former spouse has not yet claimed retirement benefits. Important distinction. If you're married, you're not eligible to start collecting your spousal benefit until your current spouse has filed for benefits. But if you're divorced, it doesn't matter whether your ex-spouse has filed or not, okay? Because keep in mind, your ex-spouse may also be filing on you, right? So however, to take advantage of this special rule, again, you must have been divorced at least 2 years, and ex-spouses can each claim spousal benefits on their former mate's earnings record, right? So hopefully that makes sense. At least gives you an idea. And if you are divorced and you don't really know what benefit you qualify for, because you don't really know what your ex-spouse's benefit is, the Social Security Administration will help you with that. They'll provide you what you qualify for, because they know what your ex-spouse is. You obviously need to provide evidence of that you were married and that you're now divorced. All right. So just in the sake of time, we'll keep humming along here. So you may also be eligible for a benefit based on a deceased spouse. So the short summary here is the survivor will receive the greater of the two benefits. So either your own or your deceased spouse's benefit. You get the higher of the two. You need to have been married at the time of death. You need to have been married for at least 9 months. However, there's a few exceptions in the case of military service or accident-related death. One slight difference, you can file for a reduced benefit as early as age 60. So for all the other benefits, the earliest you could file was 62, but as a widow or widower, you could file at age 60 for a reduced benefit, or wait till your full retirement age to get the full benefit. And again, there are no delayed retirement credits. Once you reach your full retirement age, survivors actually get a choice. You could pick to say, hey, maybe I just want to file for my own benefit, or maybe I just want to file for the survivor benefit. So I'm going to, on the next slide, kind of walk through a quick, simple case study here where we actually helped the client go through this. So we had a client who, husband and wife, a little bit of an age difference. The husband passed away at the age of 79. At the time of his death, the wife was age 65. So she was eligible, right, to file for benefits, but it would have been early. So she waited until her full retirement age, a year later, and then she had the choice to file for the benefits based on her survivor or her own. And so in her case, she filed just on the survivor benefit because she's still working, and her plan is to then switch to her own fully deferred benefit at age 70. So she's getting some money now while also letting her benefits collect the delayed retirement credits, and then when she turns 70, she's going to switch. So just a pretty cool little tip to be aware of, or if you know anyone that might be eligible for. So a few years back, this was under the Obama administration, Congress made a few changes to the Social Security rules, and Obama signed them into law. And they basically changed the rules for a couple of items that I referred to as creative claiming strategies. At the time, the press was calling them aggressive claiming strategies or referred to them as loopholes, but they were definitely strategies that we helped many clients utilize. And they were referred to as file and suspend was one, and the other one was restricted application. So first, file and suspend. What happened to that? Simple. It's gone. It doesn't exist. I'm not going to waste anybody's time even explaining what it was because it doesn't apply anymore. However, restricted application does still apply for some folks. So let's talk about that. You are grandfathered in to be eligible to file a restricted application if you were born before January 2nd, 1954, and are not yet age 70, right? So you are eligible to file what's called a restricted application if you had attained age 62, essentially by January 2nd, 2016. All right? So now, first we know whether or not you're grandfathered in and eligible for it. And maybe you're not. I'm not. I'm not eligible for this, but maybe you know somebody who is, and you might say, hey, before you file for a benefit, think about the restricted application and how that might benefit you. Now we're going to explain what that means and how that applies here in a moment. So let's go through a couple case studies that I think will help synthesize a lot of what we've gone over today. This first example, married couple, born in 1960, right? So full retirement age of 67 under current law. We have life expectancies to age 90 for each of them, just to keep things simple. Spouse 1 has a full retirement age benefit, or if you recall what Social Security calls that, their primary insurance amount is projected to be $2,500 a month. Spouse 2 also qualifies, but for a lower amount. Spouse 2's benefit is projected to be $1,000 a month. All right, so first, they are not eligible for restricted application. They didn't meet the age requirement. They're not grandfathered in. Simple. That's out of the equation. So now it becomes kind of a question of, well, when should they file, right? That's the ultimate question. And I'm just going to kind of walk through sort of two scenarios. There are other scenarios, but just to kind of illustrate an example of where it potentially could make sense for one of the spouses to file early at 62 while the other waits to all the way to age 70. So let's just kind of walk through that here in a moment. On the next slide, we're going to just sort of show, we've got here on the left-hand side, projected years, projected ages that they attain. We've got the monthly benefits for spouse 1 and 2. Then this is basically the combined annual amount each year. And then you've got the cumulative amount. So adding up every year's benefit, okay? Hope that makes sense. So here's an example of spouse 2 waits to full retirement age of 67 and files for benefits and starts getting their $1,000 a month, right? That was their primary insurance amount. Simple. The annual amount, because we have a mid-year birthday, basically they're getting benefits in October, November, and December in this example. So they get $3,000, and then the next year a full $12,000, and you can see where it's just adding up the cumulative amount. So after 3 years, they've got $27,000 from Social Security benefits. So then now they both turned 70. Because spouse 1, let's say, was still working and just wanted to defer, or maybe they weren't working, but they just wanted to defer because they recognized, oh, there's a pretty big difference in benefit, and we don't need the money. We can afford to wait because, hey, we've got some money coming in here, and we've got other savings for retirement. So I'm going to wait and lock in my highest possible benefit, because not only does that lock it in for spouse 1's lifetime, but if you recall, it locks it in for spouse 2 also as a survivor. So in the event if spouse 1 were to predecease, if something were to happen to spouse 1 in retirement, and they were to predecease spouse 2 then gets the higher of the two benefits, and so would receive the 3133 in that example. Okay? So that's part of the thought process around why it might make sense for the higher earner to wait all the way to 70. But then you also see here, oh, how come spouse 2 got a raise at 70? Well, they got that raise because they're eligible for a spousal benefit. So they filed and started getting money on their own work record, but they weren't eligible for the spouse benefit until spouse one filed. Then once spouse one filed, they got bumped up to 1/2 of spouse one's primary insurance amount. So look, it's not 1/2 of 3133, it's 1/2 of the 2,500. All right? And there you just kind of see, and then in this case, we're not showing any cost of living adjustments. We just got flat benefit levels going through. And if they both live to 90 with no cost of living adjustments, that's almost $1.1 million of cumulative benefits received. That's real money. That's a big decision. So now, why, Jason, might they consider spouse two filing early? So spouse two might say, okay, I know I'm not going back to work. For whatever reason, I know I'm done, so I'm not going to be subject to the withholding, right? We talked about that earlier. If you filed early, it'd be subject to an earnings restriction. So that's one consideration. They said, no, we're good there. Not a worry. They might say, okay, well, but it would be nice to start getting some money in sooner. So rather than waiting to 67, they're going to get 4 more years, almost 5 more years of income sooner. And then spouse one waits at 70, files, but spouse two still gets a raise, but it's not quite as big a raise because they filed early. So everything is subject to a reduction. One concept we didn't really talk about yet is the break-even point. So if we go back to the prior one, right around age 78, you see the cumulative benefits received is $463,000. Right around 78, they cross over. That's the break-even point. So in the long run, if they both live long lives to 90, they actually get a little bit less in total benefits by filing early, right? They got more when they were younger, but then once they got past that break-even point, you see that the cumulative benefit is higher by having waited and started the benefits later. Right, so that really comes down to the question of what's life expectancy, right? How long do you think you're going to live? Versus, is it nice to start getting some money early? All right, so now let's talk about restricted application. So in this case, we've got married couple, both born in 1953. Hey, they get grandfathered in. They're eligible for restricted application. Slight change. Spouse one still has the primary insurance amount of $2,500, but in this case, spouse two has a higher benefit projected at $2,000 a month. Okay? So in this case, we're just going to walk through kind of how restricted application works. In this scenario, spouse one is going to file for their benefit at their full retirement age of 66 in their case. Spouse two at that time is going to file a restricted application. All right, so I find it more helpful to look at it here with the real numbers. All right, so here we are. Spouse two, let's start here, files for their benefit at full retirement age. Like we said before, it's $2,000 a month. Excellent, they get $2,000 a month. They're going to get that the rest of their life, plus cost of living adjustment. Spouse one, though, is grandfathered in and is eligible for restricted application. So what exactly does that mean? So it means that they have the choice. They can go in, now that they're at full retirement age, and file for benefits, but restrict it to their spouse-only benefit. So they kind of get their pie and eat it too, as they say. They can start getting money now. So they get the $1,000, right, 1/2 of their spouse's benefit, while continuing to let their benefit defer and collect the delayed retirement credit, and then when they get to age 70, switch from the spouse-only benefit to their fully deferred benefit. Pretty cool. I actually just went through this scenario with my mother-in-law past weekend because she is divorced, and so ex-spouses, you're eligible for this too, so long as you meet the age requirement, right? You're grandfathered in. Then ex-spouses can do this as well. So she is now filing for a spouse-only benefit or ex-spouse-only benefit while she's going to continue to let her benefits defer. All right, so now I'm going to use this opportunity to address one of the questions we got ahead of time around the filing for spouse-only benefits. The question, I think, if I understand correctly, is can you do that online or you have to go in person? You can do it online. I actually just helped my mother-in-law do it online over the weekend. But the key is there's one question in there that asks you, are you filing for a benefit on your own work record or on someone else's work record? And so you need to basically check the box that says you're filing for your benefit on someone else's work record. Everything else is the exact same process of completing the application online, but you need to check that box. And then when you get to the end, there's a little dialog box where you can type in, any comments. And I always encourage folks to also type in there just to make it clear that says, I am filing for benefits, but I am restricting my application to the spouse-only benefit. All right. I know we're kind of pushing up here on our time limit, so I just want to make a couple quick comments on two provisions that apply to folks. In this area, if you were a federal employee and participated in the old civil service retirement pension plan, in that case, if you spent your entire career, for example, in the CSRS, the old pension plan, you did not pay Social Security taxes during those years. But then let's say you do receive the CSRS pension, but then you also work some in the private sector where you paid into Social Security, and you then receive a Social Security benefit as well as your civil service benefit. Well, in that case, you would be subject to the windfall elimination provision, which basically says your Social Security benefit is going to be reduced by some formula based on your civil service pension. I'm going to leave it at that. There's a lot more to it. It's pretty complicated, but I'm happy to help folks understand it more. And similarly, the government pension offset applies to spouses of those federal employees, right? So if you're receiving a spousal benefit on the civil service pension plan or survivor benefit, and you also qualify for Social Security, then you may be subject to the government pension offset. All right, so just kind of wrapping things up, kind of back to my original point. Social Security benefits are really valuable. There's a lot to it. It's worth thinking through and answering, some of these questions that we have on the screen, as well as many more. And so let me just sort of put this slide up to just some simple practical information. Definitely encourage you to go online, create an account, look up your information. If you are looking to file for benefits, like I said, it can be done online, or if you just prefer to go in and see someone in person, never just go down and wait in line. Always schedule an appointment before going down. It's just going to be much easier process, much more efficient use of your time. But you can also schedule phone appointments as well. So I encourage you to do that. And then if you do go, just know that you may need to provide certain pieces of evidence, like a birth certificate, or proof of citizenship, or W-2s or marriage certificates, that sort of thing. But just a quick comment: if you're applying for benefits online, they're going to ask you all that kind of information, like, okay, when were you married, and if you're divorced, when were you divorced, where were you married? Because in a lot of instances, the Social Security Administration can verify all that information through their systems, but in some instances they can't, and they're going to need you to provide the physical documentation, the evidence of that. So great. This is, I know we're kind of pushing up here on the hour, so I want to be respectful of everyone's time. So just kind of put our team here. This is the AFS Financial Group team. I know some of you are familiar with our AFS 401k Retirement Services team. So please feel free to reach out to any of the folks you see here on the screen. This is me here at the top. Again, my email address, jasond@afsfinancialgroup.com. But yeah, I'd love to talk Social Security. If you couldn't tell, I love to nerd out on Social Security. So yeah, thanks a lot for joining us. We are going to save a recording of this. It just takes a couple days to kind of get that process. So if you're interested in a recording of it, or maybe you say, oh, you know what, I'd love to have my spouse listen to this, or love to share it with a friend. Happy to make that available for you. Or yeah, so great. Thanks a lot, and please be on the lookout for our future webinars. We do these monthly on a variety of subjects. So yeah, thanks a lot.